You just checked the price of gold. $5,000 per ounce. Your stomach tightened. Not because the number scared you, because 12 months ago, gold was sitting at $2,600. It has nearly doubled in 1 year. While you were thinking about it, debating it, telling yourself you'd get in when it dipped, gold ripped 90% to the upside and didn't look back. That means if you had put $10,000 into gold at the start of last year, you'd be sitting on roughly $19,000 right now. If you'd put in $50,000, you'd be looking at $95,000. Your neighbor who bought gold coins in 2020 when everyone called him crazy, he paid $1,600 an ounce. His investment has more than tripled. He's sitting on a 200% gain, while most people's stock portfolios are barely keeping up with inflation. And here's what should really keep you up at night. The same forces that drove gold from 2,600 to 5,000, central bank buying, geopolitical chaos, a weakening dollar, Federal Reserve rate cuts, none of those forces have gone away. They're accelerating, which means the question isn't whether you should own gold, it's which of the 6 strategies I'm about to show you is the right way for you to profit from what's happening right now. Let me give you some numbers that'll put this in perspective. Central banks around the world bought over 1,000 tons of gold in each of the last 3 years. That's the highest sustained purchasing pace in recorded history. China's central bank has been buying gold for 15 consecutive months and shows no signs of stopping. They're not buying gold because they think it's pretty. They're buying because they're actively moving away from the US dollar as a reserve currency. The US dollar index is sitting near a 4-year low. When the dollar weakens, gold strengthens. That's not a theory. That's a mathematical relationship that has held for decades. The Federal Reserve is expected to cut rates multiple times this year. Lower rates reduce the opportunity cost of holding gold, which means more money flows into it. And geopolitical tensions between the US and Iran, between Russia and Ukraine, between China and Taiwan are creating the kind of global uncertainty that sends institutional money straight into safe haven assets. Gold is the ultimate safe haven. Gold has returned over 10% annually on average over the last 25 years. Since 2020, gold has surged over 230%. It outperformed the S&P 500, bonds, real estate, and crypto over that period. This is not a speculative meme coin. This is the oldest store of value in human history doing exactly what it was designed to do. My name is Phil, and I've spent years breaking down the investment strategies that actually build wealth through every market cycle. Not just the bull runs, not just the easy money periods, the strategies that work when everything else is falling apart. If you want to understand how to profit from gold the right way, not just buying random coins from a late-night TV commercial, but the actual institutional-grade strategies that smart money uses, make sure to hit that subscribe button and give this video a thumbs up, because the 6 methods I'm about to break down range from beginner-friendly to advanced, and by the end, you'll know exactly which ones fit your financial situation. Here's my thesis. Gold is not just a hedge anymore. It's a profit engine, and most people are either ignoring it completely or doing it wrong. They're paying massive premiums on physical coins. They're buying the wrong ETFs. They're missing the tax advantages. They're timing it incorrectly, or they're sitting on the sidelines watching it climb another 20% while they wait for a dip that never comes. There are 6 distinct ways to profit from gold, each with different risk profiles, tax implications, and return potentials. Some require as little as $50 to start. One of them lets your gold grow completely tax-free. Another gives you leveraged exposure to gold's upside without actually owning any gold at all. I'm going to walk you through each one, show you the math, and tell you which ones I think make the most sense in today's market. Let's start with the one most people get wrong. Strategy number 1 is physical gold, bars and coins. This is what most people think of when they think of investing in gold, and it's the strategy most people execute poorly. Physical gold has one massive advantage that no other form of gold investment has. There is zero counterparty risk. When you hold a gold bar in your hand, there is no company that can go bankrupt, no exchange that can freeze your account, no bank that can deny you access. It's yours. Period. In a truly catastrophic financial scenario, physical gold is the only form of wealth that cannot be digitally frozen, seized, or devalued by a government printing more of it. But here's where people mess up. They buy gold coins from dealers who charge 15 to 25% premiums over spot price. If gold is $5,000 an ounce and you're paying $6,000 for a 1-ounce American Eagle, you need gold to go up 20% just to break even. That's not an investment. That's starting the race 20 yards behind the starting line. The smart way to buy physical gold is to focus on bars and rounds from reputable dealers with the lowest premiums possible. You want to be paying 2 to 5% over spot, not 15 to 25. Buy 1-ounce bars from established mints, skip the collectible coins, skip the limited editions, skip anything that charges you extra for packaging or certification, unless you specifically a numismatic collector, which is a completely different game. Storage is the other issue. A home safe works for smaller amounts, but if you're holding $50,000 or more in physical gold, you need to think about insured vault storage. Companies like Brinks and Loomis offer allocated storage where your specific bars are segregated and insured. The cost is typically 0.5% to 1% per year. That's the cost of sleeping at night, knowing your wealth is protected. Physical gold gets taxed as a collectible by the IRS. That means a maximum federal rate of 28% on long-term gains, which is higher than the standard 15 to 20% capital gains rate on stocks. This matters. It means physical gold has a built-in tax disadvantage compared to other forms of gold investment. Keep that in mind because Strategy 4 solves this problem entirely. Bottom line on physical gold, it's the foundation. It's insurance. Everyone should own some. 5 to 10% of your net worth in physical gold is the baseline recommendation for most financial strategists. But it's not the best way to maximize your returns from gold's price movement. That's where the next 5 strategies come in. Strategy number 2 is gold ETFs. This is the simplest, most liquid, and most cost-effective way for most people to profit from gold's price movement. A gold ETF tracks the price of gold and trades on the stock exchange just like a stock. You can buy it in your brokerage account in 10 seconds. The 2 biggest are GLD and IAU. GLD is the SPDR Gold Shares Fund, the largest physically backed gold ETF in the world. IAU is the iShares Gold Trust. Both hold actual physical gold in vaults, and their share prices move in lockstep with the gold spot price. The expense ratios are tiny. GLD charges 40 basis points per year. IAU charges 25 basis points. Compare that to the 2 to 5% premium plus storage costs of physical gold, and you can see why most investors who want gold price exposure use ETFs instead. The big advantage of gold ETFs is liquidity. You can buy $10 worth or $10 million worth and sell it in seconds during market hours. Try selling $100,000 worth of gold bars on a Tuesday afternoon. It's not happening quickly. Here's the math. If you had bought $10,000 of GLD at the start of 2025 when gold was $2,600, that position would be worth approximately $19,000 today. Same return as physical gold, but with no storage costs, no insurance, no dealer premiums, and you can sell it with one click. There are also leveraged gold ETFs for aggressive traders, funds that give you 2 times or 3 times the daily movement of gold. But I want to be clear, these are trading instruments, not investments. If gold goes up 2% in a day, a 2 times leveraged ETF goes up 4%. But if gold drops 6, you lose 6. And because of something called volatility decay, leveraged ETFs lose value over time even if gold goes sideways. Use them for short-term trades. Never hold them long-term. Gold ETFs are taxed differently depending on the structure. GLD and IAU are technically grantor trusts that hold physical gold, so they're taxed at the collectibles rate of 28%, just like physical gold. However, if you hold them inside a Roth IRA, which we'll talk about in Strategy 4, the tax rate is 0. Keep that in the back of your mind.
If you've made it this far, you already understand more about gold investing than 90% of people who call themselves investors. But don't stop now, because strategies 3 through 6 are where the real money is made. Strategy 4 is the one that most people don't know exists, and strategy 5 is how Wall Street actually plays the gold market. Stay with me. Strategy number 3 is gold mining stocks. And this is where things get interesting, because mining stocks give you leveraged exposure to the price of gold without the risks of leveraged ETFs. Here's why. A gold mining company has fixed costs to extract gold from the ground. Let's say it costs a company $1,200 per ounce to mine gold. When gold is at $2,500, their profit margin is $1,300 per ounce. But when gold goes to $5,000, their costs don't double. Their costs might go up slightly to maybe $1,400, but their profit margin explodes from $1,300 to $3,600 per ounce. That's a 177% increase in profit from a 100% increase in the gold price. The mining stock amplifies gold's move. This works both ways. If gold drops, mining stocks drop harder. But in a bull market for gold, which is what we're in right now, mining stocks are the high-octane play. There are two categories. Senior miners are the big, established companies. Think Newmont, Barrick Gold, Agnico Eagle. These are profitable, dividend-paying companies with decades of operational history. They're the blue chips of the gold mining world. Then there are junior miners, smaller companies that are still exploring or developing mines. These are higher risk, but potentially much higher reward. A junior miner that discovers a significant gold deposit can go up 500 to 1,000%. But they can also go to zero if the deposit doesn't pan out. For most people, I'd recommend starting with a gold miners ETF like GDX, which holds the senior miners, or GDXJ, which holds the juniors. This gives you diversified exposure to the mining sector without the risk of any single company blowing up your portfolio. GDX has historically moved about 2 to 3 times the percentage move in gold. So when gold goes up 10%, GDX tends to go up 20 to 30%. Over the last year, while gold is up 90%, some mining stocks are up 200 to 400%. The tax advantage over physical gold is significant. Mining stocks and mining ETFs are taxed as regular capital gains, not collectibles. If you hold for more than a year, you're looking at 15 to 20% rates instead of the 28% collectible rate. On a $100,000 gain, that's an $8,000 to $13,000 tax savings just from choosing the right vehicle. Strategy number 4 is holding gold inside a Roth IRA. And this is the strategy that changes the entire math of gold investing because it eliminates taxes completely. Remember, physical gold and gold ETFs like GLD are taxed at 28% as collectibles. Mining stocks are taxed at 15 to 20%. But inside a Roth, the tax rate on all of them is zero. 0 on the gains, 0 on the dividends, 0 when you withdraw, 0 when your heirs inherit it. You can hold gold ETFs, mining stocks, and mining ETFs directly inside a Roth IRA at any major brokerage. Fidelity, Schwab, Vanguard, they all support it. You just buy GLD or GDX inside your Roth the same way you'd buy any stock. If you want to hold physical gold in an IRA, you need a self-directed gold IRA, which requires a specialized custodian. The gold must meet IRS purity requirements of 0.995 fine and be stored in an approved depository. The setup is more complex, but it allows you to hold actual bars and coins inside the tax-free Roth wrapper. Let's do the math. Say you put $7,000 per year into a Roth IRA invested in gold-related assets. If gold continues its historical average return of about 10% annually, in 20 years, that's roughly $450,000. In a taxable account, you'd owe anywhere from $67,000 to $126,000 in taxes on those gains, depending on the vehicle. In a Roth, you keep every single penny. That's the difference between retiring with $450,000 and retiring with $324,000. Same investment, different wrapper. Over a $100,000 of difference. If you do nothing else from this video, open a Roth IRA and start buying GLD or GDX inside it. That single decision will save you more money over your investing lifetime than any gold price prediction ever could.
Strategy number 5 is gold futures and options. This is how Wall Street and institutional investors actually play the gold market. It's not for beginners, but if you understand it, the leverage and flexibility are unmatched.
A gold futures contract is an agreement to buy or sell 100 troy ounces of gold at a specific price on a specific date. At $5,000 per ounce, one contract controls $500,000 worth of gold, but you don't need $500,000 to buy one. You need margin, which is typically around 10 to 12% of the contract value, roughly $50,000 to $60,000. This means you're getting roughly 10 to 1 leverage. If gold goes up 2%, your position gains 20%. If you had bought one gold futures contract at the start of 2025, when gold was $2,600, that contract would have gained approximately $240,000 in value on a $60,000 margin deposit. That's a 400% return on capital deployed. But if gold had gone down 10% instead of up 90%, you would have lost the entire margin deposit and owed additional money. Futures can and do wipe people out. The leverage cuts both ways. Options are the safer way to play this. A call option on gold gives you the right, but not the obligation, to buy gold at a specific price. Your maximum loss is the premium you paid for the option. If gold doesn't reach your target, you lose the premium and nothing more. If gold rockets higher, your gains can be enormous. For example, if you had bought a one-year call option on gold with a $4,500 strike price when gold was at $2,600, that option would have been relatively cheap because gold at $4,500 seemed unlikely. When gold blew past $5,000, that option would have returned thousands of percent. Traders who positioned this way correctly made generational wealth in a single year. I want to be crystal clear. Futures and options are advanced strategies. If you don't fully understand margin requirements, contract specifications, expiration mechanics, and risk management, stay away. Start with strategies 1 through 4 and learn these instruments with paper trading before you commit real money. Strategy number 6 is dollar cost averaging into gold. And this is honestly the most important strategy on this list because it's the one that eliminates the biggest mistake people make, trying to time the market. Here's the problem. Gold is at $5,000. Every part of your brain is screaming that it's too expensive. You missed the move. It's too late. You'll wait for a pullback. Except that exact thought process is what stopped people from buying at $2,000 and at $3,000 and at $4,000. They were all too expensive at the time, and every single one of those prices looks like a steal in hindsight. Dollar cost averaging solves this by removing emotion from the equation. You invest a fixed dollar amount on a fixed schedule regardless of price. $200 on the first of every month, $500 on every paycheck, whatever fits your budget. When gold dips, your fixed amount buys more ounces. When gold spikes, your fixed amount buys fewer. Over time, your average cost per ounce lands somewhere in the middle, which is almost always better than trying to time the perfect entry. Let me show you the math. If you had invested $500 per month into gold starting in January 2020, when gold was around $1,600 per ounce, your total investment would be $36,000 over 6 years. At current prices near $5,000, that position would be worth approximately $78,000, a 116% return, without ever timing a single trade, without ever checking a chart, without any stress about whether today is the right day to buy. The beauty of DCA is that it works whether gold goes up, down, or sideways in the short term. It only requires one thing, that gold trends higher over the long term. And over the last 25 years, gold has averaged 10.9% annual returns. Over the last 5 years, it's averaged significantly more than that. The trend is your friend, and DCA is how you ride it without getting thrown off by volatility. You can DCA into physical gold through monthly purchases from a dealer. You can DCA into GLD or IAU through automatic investments in your brokerage account. Or you can DCA into GDX or GDXJ for leveraged exposure. The vehicle matters less than the consistency. Pick one and do it every single month. Here's the mindset shift. Most people think of gold as something you buy when you're scared, a fear trade, a crisis asset. That's the old way of thinking. The new reality is that gold is a structural trade being driven by forces that will persist for years. Central bank de-dollarization, fiscal deficits that ensure the printing press keeps running, geopolitical fragmentation that isn't going away. This isn't a spike, it's a regime change. The people who understand that are accumulating. Everyone else is watching. Let me tie all of this together. 6 strategies. Physical gold is your insurance, your foundation, 5 to 10% of net worth. Gold ETFs are your simple, liquid exposure. Buy them in 2 clicks. Gold mining stocks are your leveraged upside play, 2 to 3 times gold's returns. A Roth IRA is your tax shield, 0 taxes on all gold gains forever. Futures and options are your advanced tools, massive leverage for experienced traders. And dollar cost averaging is your execution strategy, the discipline that removes emotion and ensures you actually build the position instead of just thinking about it. You don't need all 6. If you're just starting out, open a Roth IRA, buy GLD or GDX inside it, set up automatic monthly contributions, and you've just combined strategies 2, 4, and 6 into a single tax-free automated gold accumulation machine. That alone puts you ahead of 99% of people who say they want to invest in gold but never actually do it. Your future self, the one looking back 5 years from now when gold is potentially at levels that seem unimaginable today, is either going to thank you for starting to accumulate when the signals were this clear, or they're going to wonder why you had all the information, understood the thesis, and still didn't act. The central banks are buying, the dollar is weakening, the geopolitical landscape is deteriorating. Every major institution on the planet is increasing their gold allocation. The question is whether you're going to join them or watch from the sidelines again. So, here's what I want from you. Which strategy are you going to implement first? Are you a physical gold buyer, an ETF investor? Are you going to open that Roth IRA, or are you starting a DCA plan? Drop it in the comments. I read every single one, and the discussions in this community are phenomenal. And if you want me to go deeper on gold mining stock analysis or the specific Roth IRA setup process, tell me below. That's coming next if you want it. I'll see you in the next one.
Quick disclaimer. Everything in this video is for educational and entertainment purposes only. I am not a financial advisor, and this is not personalized investment advice. Always do your own research before making any financial decisions.